You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.
Hello and welcome to our PGIM India Insights series. This is a podcast dedicated to bringing you a deeper understanding of the markets and investment strategies from the experts at PGIM India Asset Management. In an economy where central bank actions shape the cost of capital, understanding the fixed income space is more crucial than ever. Well, on this episode today, we are diving deep into the Indian debt market, focusing on how investors can navigate the current environment. So joining us for this crucial conversation is our expert Puneet Pal, Head of Fixed Income at PGIM India Asset Management, and Jatin Gulati. Over to you, Jatin.
I'm Jatin, your host, and today I have with me our very own Puneet Pal, Head of Fixed Income, who will take us through the current market trends and how should investors navigate their fixed income allocations going ahead. Hello, Puneet.
Hi, Jatin.
So, Puneet, from RBI's perspective, this year has been quite eventful, right? We have seen 100 basis points of rate cut. Growth has been broadly in line, or I would say now above expectation. We had the latest GDP number of 8.2. Inflation has been constantly drifting lower. So, Puneet, how is bond market receiving all these numbers as in terms of yield reaction, and are you expecting another rate cut in the upcoming policy of 5th of December or even a change in stance?
Yeah, Jatin, you are right that this year has been quite eventful for the bond markets. We have seen the bond yields trending lower in the first half of the year as RBI cuts rates quite aggressively, and thereafter we have seen retracement in the yields as the bond market since the end of the rate cutting cycle after the 100 basis points of rate cut and somewhat adverse demand supply dynamics, especially at the longer end of the yield curve. So all those, I will say, things have proven to be slightly more volatile, especially since the June rate cut. And going ahead, we do believe that there is scope for one more rate cut, an incremental rate cut of 25 basis points, given the fact that inflation has been trending lower than RBI's forecast, and in all probability it will come in the upcoming policy, probably RBI will revise again their inflation forecast lower. So overall, the lower inflation has given some incremental scope for rate cut, which was implicitly hinted in the last policy, MPC policy also. So we do expect another 25 basis points of rate cut in the December 5th policy. However, we do not expect any change in the monetary policy stance, simply because of the fact that we don't see much scope for deeper rate cuts or any rate cut beyond 25 basis points. We think this will be the last rate cut, and the reason behind that is that the growth has been pretty strong, and we also expect inflation to inch higher in 2026. So overall, we do believe that there will be one more rate cut without any change in the monetary stance, but don't see any incremental rate cut beyond the 25 basis points that we expect on 5th of December.
Sure, Puneet. So, Puneet, in extension to that, are the Indian bond market sensitive to US Fed or even other central bank cutting rates, which we have seen the trend started 1 year back almost? And if there is a global growth slowdown sometime next year, which there are some readings also coming in, could there be a spillover effect to India as well? And to what extent, as per your understanding?
Well, I think it's an important point that you have touched upon, Jatin. Definitely, global macro developments do have an impact on domestic bond yields. Though the predominant factors remain the domestic economic variables, as we have seen time and again that bond markets being majorly domestically owned, your domestic economic fundamentals play a predominant part in shaping up the yield curve or deciding the future of the movement in the yields. But definitely global macros do have an impact. And here what we have seen is that the yield spreads between developed and emerging markets have compressed over the last couple of years. If we see in the Indian context also, the Indian and the US bond yields have compressed over the last couple of years relative to their historical spreads. I think this is due to improvement in our economic fundamentals or emerging market as a whole also, and a deterioration relatively in the developed markets economic fundamentals or economic variables. We have seen that their fiscal deficit and inflation has been a challenge, whereas our fiscal deficit and inflation has been trending lower compared to US or other developed markets. So those factors have led to emerging market yields actually coming down over the last 1 year, which is in stark contrast to the rise in yields in developed markets, especially in Europe. and Japanese bond yields have also been going up, as you highlighted. So overall, I think this divergence is happening because of relatively different economic variables in emerging markets, including India. Your economic variables have been better, or I will say the key factors which bond markets look at, which is fiscal deficit and inflation, they have been in control, whereas in developed markets and in Japan, they are proving to be a challenge for the policymakers. So I'll just say that Japanese bond yields, I mean, this has been a subject or a topic of discussion over the last couple of years, not right now. Right now, it's gaining currency because people do expect further increase in Japanese bond yields and their rates. So currently, we don't see that the markets are overly bothered about that. They don't seem to be too much concerned on that factor, but we think that it can be a major macro risk going ahead. Maybe in the next 2 years, it can prove to be a major macro risk. And we are closely monitoring the developments in the Japanese bond markets. And we are also factoring in this risk while taking a forward view on our portfolios. So definitely it's a major macro risk, I'll put it like that. Though currently the markets are tolerating the rise in Japanese bond yields pretty well. But in our portfolios, in our forward-looking views, we'll definitely factor that risk. And we think it can be a major macro risk in the next couple of years.
Sure. Yeah, Puneet, so I think that explains very well. But apparently, Puneet, so another pressing issue for RBI has been the rupee depreciation, or I would rather say the sharp rupee depreciation, this year.
Yeah.
Because I think at a country, so we have been, I think, if I'm correct, the worst performing in terms of the currency. Although they have been actively intervening without giving any guidance to a particular level. But how do you see the liquidity situation, going ahead due to that particularly? And also, are you sensing any stress building in the NBFC issuances?
Well, I'll see the currency depreciation as more of a demand for dollars. I mean, obviously, that means that the supply is not commensurate with the demand. That's why we are seeing a lower or a depreciating currency. But I think RBI has been intervening in the markets quite aggressively in the FX markets or the currency markets, both in the spot and the forward segments. And this intervention is in line with RBI's implicit policy of not targeting any particular level, but to intervene to smoothen any volatility, which they have been doing over the last 1 year almost. But as they say that there is no free lunch in the markets, the currency intervention has come at a cost of reduced liquidity in the banking system, because we have seen that as RBI intervenes to sell dollars in the markets, you drain out rupee liquidity. And in spite of the CR cuts that have happened so far, 100 basis of CR cuts, we have seen the durable liquidity in the banking system coming down by almost 1.5 lakh crores over the last 4 months. So that's a price that probably the central bank is paying in terms of intervening to smoothen out the currency volatility. But yes, it's slightly surprising that despite relatively strong fundamentals that the Indian economy is having in well-contained fiscal deficit, lower inflation, very good and strong GDP growth, we are still seeing some outflows on the portfolio side, which is putting some pressure on the currency. But we think that going ahead, probably, I mean, from a valuation perspective, rupee looks pretty cheap. So going ahead, probably rupee is likely to stabilize around this 89 to 90 levels. And we do expect that RBI will continue to intervene to smoothen the volatility in the currencies. On liquidity, I will just say that apart from the currency intervention by the central bank, you also have the variable of currency in circulation, which generally picks up during the last quarter of the fiscal year. And this time also, in conjunction with the currency intervention, if currency in circulation or CIC, as we say, goes up in the last quarter, then RBI is likely to conduct OMOs to ease any liquidity strain or liquidity tightness, because they've already done 100 basis of CR cut. So any incremental tightness in liquidity, I think, will be addressed by RBI through OMOs. And that's what the bond markets are also expecting, which can support the sovereign bond yields, which have been under pressure. So yes, liquidity has been tight. That's because of RBI's intervention in the FX markets. It can tighten more because of the currency leakage, which is CIC. And to address those liquidity concerns, I think RBI will do OMOs. The quantum of OMOs is difficult to say right now, but we do believe that around 2 lakh crores of OMOs will be needed. Market expectations are divided between 1.5 lakh crores to all the way to 3 lakh crores in terms of OMOs. But we are more of the view that around 2 lakh crores of OMOs probably will be required by RBI to ease the liquidity tightness going ahead.
Yeah, Puni. So I think that's quite helpful, and I'm sure that you rightly mentioned. So I think RBI has been trying to keep the liquidity on tap available wherever required. In fact, due to maybe the lingering tariff issues and still U.S. India trade pact is yet to be sealed. So they are still trying to protect that set of segment which is getting impacted or might be impacted once they finally come onto a conclusion and there could be any spillover effect. So thanks, Puneet. So finally, obviously can't wind this up without having your thoughts that from investors' perspective, how should they plan their fixed income allocations going ahead? And maybe a broader understanding I would like to have, or our viewers, our listeners would like to have, that which part of the curve looks more attractive from a risk to reward perspective.
Definitely. I think, first of all, every investor has to allocate depending upon his or her appetite for risk and expectations of return. I think risk reward is the predominant factor which an investor should take into account while doing any investments or asset allocation. Coming to pure fixed income per se, we do expect, or we are of the view that the SDL curve or the state government securities curve is looking pretty attractive given that the spreads are on the higher side compared to the central government securities. So we think anywhere between 5 to 10 year on the state government curve is pretty attractive. It offers a better risk adjusted investment opportunity right now, along with 2-3 year maturity corporate bonds. So investors can look at allocating into funds which are overweight on state government securities or 2-3 year corporate bonds, as we think that these segments are offering a better risk reward to the investors right now, given that they are trading at a higher spread compared to historical averages vis-a-vis government securities, central government securities. So that's what we probably will recommend, looking at state government securities and 2-3 year corporate bonds.
Great. Thanks, Puneet. So I'll just quickly sum it up, Puneet. So, exactly what the key takeaways from, our discussion has been. So a couple of points and maybe, you can add as a closing comment. So we do believe that there is obviously there is a room for one more rate cut between the upcoming policy or February policy. It depends upon, how the incoming data the RBI is reading, but we don't see any change in stance as, you are saying that growth has been pretty decent so far, but there is a very high chances that inflation might inch up going ahead. Another thing which you mentioned that, that from obviously there are global headwinds and, since the tariff and, the geopolitical issues which are there, and RBI has been trying to intervene in the currency market, but they are keeping the liquidity quite available. Or I would say whenever the situation comes, they are trying to intervene by doing regular OMO or interventions by the viable tools. Lastly, I think on the product side, what our listeners, whether it's the clients, whether it's advisors, so we think that the SDL curve, which is the state development loans, which are there, the 5 to 10 year option on the duration looks pretty attractive. So investors can look at options available on the SDL with a maturity of 5 to 10 year, and followed by a 2 to 3 year corporate bond. So we still are of the view that the spreads are pretty attractive in that space. So clients can definitely look at allocating money in this option also. So Puneet, maybe you can just
Yeah, I think you have summed it pretty well, Jatin. But just to add that yes, we do think that there will be one more 25 basis rate cut, most probably in the upcoming 5th December MPC policy. There are global headwinds in terms of steeper yield curves and the Japanese bond worries. Bond yields rising, those worries are there in the market. So we always keep that on the back of our minds while constructing our portfolios or taking a forward-looking view. So a steeper yield curve probably is there to stay globally and in India also, as we have seen adverse demand supply challenge in the Indian long end of the Indian bond markets, which have led to steeper yield curves or the yields rising more at the long end of the curve, which again has given opportunities, as you rightly put it, in some of the segments, which is we believe that 5 to 10 year SDL securities or state government securities plus 2-3 year corporate bonds, they offer a decent risk adjusted opportunity to the investors. Though I will just like to add that the longer end of the curve at around 740, 745 yield can also be used by the investors tactically. But as I said, from a structural perspective, SDL and corporate bonds look better, especially lower duration SDL and corporate bonds. But tactically, if one has to choose, then probably one can look at the long end also. But purely from a tactical perspective. So overall, we do think that we are coming to the end of the rate cutting cycle, but opportunities do exist for investors, especially in the SDL and the corporate bond curve.
Great. So thank you, Puneet, for sharing your valuable insight. I'm sure it has been pretty useful to our listeners. And thank you everyone for joining in on the PGIM India Insight series, and we'll connect with you in the next one.
Well, that was quite interesting and a very insightful conversation, right? And that was extremely informative too. Puneet, your insights on navigating the yield curve and what to watch out for in the next few policy cycles have been invaluable for our listeners. Thanks to all of you guys for tuning into this episode of PGIM India Insights.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.